Hello everyone. Welcome back to the channel. In our previous lesson, we explained the difference between cash accounting and accrual accounting. Today, we're taking it further. We're going to look at practical, real-life transactions and record them step by step under both methods so you can clearly see how they affect journal entries, the income statement, the balance sheet, and profit. By the end of this lesson, you won't just understand the theory, you'll see the difference in action. Let's begin. Scenario 1. Service performed on credit. The situation: on January 10th, a consulting business performs services worth $10,000. The customer will pay in February. Under cash accounting, since no cash has been received in January, no journal entry is recorded. Revenue will only be recorded in February when cash is received. February, when cash is received. Journal entry: debit cash $10,000. Credit revenue $10,000. Revenue appears in February. Under accrual accounting, revenue is recorded when it is earned January. January entry: debit accounts receivable $10,000. Credit service revenue $10,000. Revenue is recognized immediately. February entry: when cash is collected. Debit cash $10,000. Credit accounts receivable $10,000. Notice something powerful here. Under accrual accounting, February does not increase revenue. It simply converts receivable into cash. Scenario 2. Expense incurred but paid later. The situation: in January, the company receives an electricity bill of $3,000. Payment will be made in February. Under cash accounting, no payment in January, no expense recorded. February when paid. Debit electricity expense $3,000. Credit cash $3,000. Expense is recorded in February. Under accrual accounting, expense is recorded when incurred January. January entry: debit electricity expense $3,000. Credit accounts payable $3,000. February entry when paid. Debit accounts payable $3,000. Credit cash $3,000. Again, February does not create new expense, it only clears the liability. Scenario 3. Customer pays in advance. The situation: on January 5th, a client pays $8,000 for services to be provided in February. Under cash accounting, cash received in January, revenue recorded immediately. Debit cash $8,000. Credit revenue $8,000. Revenue appears in January, even though work has not yet been done. Under accrual accounting, revenue is recorded when earned, not when cash is received. January entry: debit cash $8,000. Credit unearned revenue $8,000. This is a liability because the company owes services. February when service is performed. Debit unearned revenue $8,000. Credit service revenue $8,000. Now revenue is properly recognized. Comparing the income statement impact. Let's summarize January under both methods using our scenarios. January transactions: $10,000 service performed, not yet paid. $3,000 electricity used, not yet paid. $8,000 received in advance. January profit under cash accounting. Revenue, $8,000. Expenses, $0. Profit, $8,000. Looks profitable, right? But the company hasn't even delivered that $8,000 service yet. January profit under accrual accounting. Revenue, $10,000. Expenses, $3,000. Profit, $7,000. This reflects actual performance. Revenue earned. Expenses incurred. Advance payment not counted yet. This is why standards like International Financial Reporting Standards and Generally Accepted Accounting Principles require accrual accounting for most companies. It gives a more faithful representation of performance. Balance sheet differences. Under accrual accounting in January, the balance sheet shows assets: cash $8,000. Accounts receivable $10,000. Liabilities: accounts payable $3,000. Unearned revenue $8,000. Under cash accounting, you would only see cash $8,000. No receivables, no payables, no unearned revenue. This means accrual accounting provides more complete financial information. Key lessons from today. Cash accounting records transactions when cash moves. Accrual accounting records transactions when value is created or consumed. Accrual accounting separates performance from cash flow. Journal entries under accrual accounting often involve receivables, payables, and unearned revenue. Profit can look very different under each method. This is not just a technical difference, it can completely change how a business appears to be performing. If this practical breakdown helped you understand the real difference between cash and accrual accounting, make sure you like the video and subscribe to the channel. See you in the next class.